Hey there, hope all is well. Back at you today with some more RTD news updates. And today's articles are more of a variety, predominantly those covering a lot of recent data released, as well as the things happening surrounding the dollar, as well as the service sector numbers that came out today. And so the first article here is Dollar Tumbles from Wall Street. The next one has to do with the timetable of the dollar's demise. The next one is reference to helicopter money. The next one is to Mr. Draghi nears his QE3. The next one is a celebration or a idea that the ECB has now purchased up to $1 trillion thus far in QE bond purchases. And the last one here has to do with actual data there released from ISM and PMI numbers. So back to the first one from Wall Street Journal today. It's entitled "The Dollar Tumbles After Weak Service Sector Data." So here it just starts off with a little graph, basically showing you how within the last, a couple of hours or whatnot, the dollar has plunged, and then it gives you a little insight as to how this type of data here, as well as all the recent data with the job sector and things like that, doesn't really pan out well for the idea of a September rate increase. And so basically just a little information here says the WSDJ dollar index, which measures the U.S. currency against 16 others, fell 0.8% to 86.03. The dollar was down against the Japanese yen, British pound, and many emerging market currencies. On Tuesday, a report from the Institute for Supply Management showed a gauge of sector service activity had fallen in August to its lowest since February 2010. So that information there is definitely not good when we're supposed to be in an economic recovery. And then read on a little bit more. It says that follows Friday's disappointment non-farm payrolls report. The Labor Department report showed employers added 151 jobs last month, below the 180,000 jobs that was expected. Analyst says the reports add to doubts about the Fed's path for raising interest rates in the coming months. Higher rates tend to boost the dollar by making it more attractive to yield-seeking investors. Therefore, there will be no rate hike. So basically, just gives a little idea as to what the percentages are of it actually been raised. And it says markets are now pricing in an 18% chance of a rate hike at the Fed September meeting, down from 30% before the ISM report. So definitely not good news here. And then you also know it's not good when the South African rand, is doing well against the dollar, as well as the Mexican peso. So just more news here from Wall Street Journal. If you guys are interested, feel free to check it out below. Here's another interesting article from James Rickards from the Daily Reckoning, and it's entitled "A Timetable for the Dollar's Demise." And so basically, if you follow James Rickards' works, he's a big SDR guy that kind of thinks that the world is going to shift to the SDR as probably the next global reserve currency in the meantime, as things are being ironed out and people are moving away from the dollar. But here's an interesting article. It's quite lengthy, so I won't go through all of it, but it has to do with the idea that he lists here several events. I want to say about 9 or so meetings that have taken place throughout last 100 years or so, that had to do with different things that kind of restructured the value of the dollar in reference to other currencies. And it was all planned events that were just set up by the powers that be in certain countries at certain times that brought about the purpose of what they were aiming to do, which was to devalue the dollar according to when they needed it and how. So it's quite interesting to read all that and things like that. But just to scroll down to the bottom to get into some more of the media things, he talks about. Let me see here. And the point is that monetary earthquakes happen from time to time. We just noted 9 big ones in the past 100 years, but there were many others, including the sterling crisis of 1992, when Soros broke the Bank of England, the tequila crisis of 1994, when the Mexican peso devalued 50% in a matter of months. These monetary earthquakes move in both directions. Sometimes the dollar is a huge winner, as in from 80 to 85, and sometimes it loses a large part of its value from 71 to 80 and 85 to 87. So also, all these times here are mentioned above if you want to find out more. The key for investors is to be alert to behind-the-scenes plans of the global monetary elite and anticipate the direction of the next big move. And so that's kind of what this is about. And so he goes into some recent or some upcoming events that he believes will be the catalyst for the demise of the dollar, as he says. So he says what will happen in the next 5 weeks is just as significant as many of the monetary earthquakes mentioned above. There are 3 major events happening in rapid sequence. Here's the list. On September 4th, The G20 leaders meet in Hangzhou, China, September 30th. The yuan officially joins the SDR basket of currencies. On October 7th, the IMF holds its annual meeting in Washington, D.C. You might be tempted to dismiss the calendar as business as usual. G20 leaders meeting happenings every year. The SDR basket has been changed many times in the past. IMF have global meetings twice a year, yada, yada, yada. But then he goes on here to list some time frames of things that have happened over the last 4 or 5 years or so since the crisis of 08, 09. That's kind of led up to this moment where this was by design. You know, the whole IMF and SDR basket kind of coming into major news nowadays. And so just some more things to check out here if you want to read into more depth how this event here where he paints the SDR as being the next global liquidity measurement is a planned event, and it started in 2009, 11, 15, 16, 16, so on and on and on to this date it's coming. So great article here. I think it's definitely a different spin off of what's happening and going on globally, especially surrounding the dollar. So good articles below if you're interested. Now we're speaking of the dollar tumbling and the dollar demise. Here's something here that I believe in the next couple months might get more mention from alternative media as well as mainstream media. So this article here is from Market Watch, and it's the typical spiel on helicopter money and what it is and things like that. But I think the writer here took a kind of a different spin and being more specific, as in identifying 2 direct means of stimulating the economy in the form of helicopter money. So it's entitled "Helicopter Money May Give the Fed Inflation It Wants." And so it goes on to talk about how the whole idea of QE and things like that were introduced since 2008 by lower interest rates and things like that. And then he pretty much hints at the fact that Ben Bernanke, who implemented the idea or kind of came up with the idea of, you know, as he put it here, whipping the donkey until he gets the type of economic growth needed. And so he basically said here, he's quoted here as saying, Bernanke is whipping the donkey that can only grow at 1%, this economy, because he thinks it's a racehorse that should be growing at 3%. So he's going to keep on whipping this donkey until it either drops dead or turns into a racehorse, which is unlikely, and I am betting on dead. And so it has to do with central bank's latest tool for whipping the donkey is helicopter money, a phrase coined by economist Milton Friedman that suggests a helicopter dropping currency from the sky and creating instant inflation. So it quotes here, it has to do with the article or paper came from Toby Nagel, a UK-based asset manager, who kind of gives 2 ways in which helicopter money will be implemented or will be looked at, all of the idea of creating inflation. And one of them here, just to scroll down, I pause. It gives a basic spiel of what has been so far as QE. And then it talks about, by definition, the quantitative easing policy, central bank purchase of debt in the UK, US, UK, Japan are already counted as helicopter money, but there are newer and stranger versions of a central bank conjuring money to buy debt. First, a bank may buy debt specially issued by government's treasury meant only for it and otherwise non-marketable. The special issuance of debt may also be perpetual. That is, this is what Bernanke recommended as an option for Japanese lenders earlier this summer. An even stranger version of this approach is when the perpetual debt has no coupon. As the Financial Times explains, a zero coupon bond, of course, says no interest. It is issued at a discount to face value and pays the the principal plus interest into the interests as maturity. All of its value depends on the one payment it will make on the day of maturity. But if a zero coupon bond has no maturity or is perpetual, the owner never receives a payment, interest, or principal. In other words, it's a worthless security. So here are just basically 2 methods in which the writers here kind of contend with the idea that the next round of quantitative easing will be directly to the government, and it might be in the form of issuing some form of debt by the government that is basically meant to just print or inject liquidity right away with it being not owed on any end or not responsible or not being held responsible for being paid back by anyone. So just more means of injecting more funny money, more counterfeiting of the Federal Reserve notes into the system. And then it goes on to the bottom and basically says that, however, it would also hurt the middle class, which is already under pressure from wage stagflation. As Chancellor puts it, talking with reference to this guy here who's commenting as well, households holding cash and other forms of paper wealth would see their capital evaporate. the long-suffering middle classes will become even more stretched and also certainly a greater deal angrier. So welcome to the brave new world of central bank intervention. So basically, any method they choose to do as far as stimulating the economy is going to ultimately hurt the middle class and those that rely upon saving and dependent upon their future spending in Federal Reserve notes. So just more happening, more news right there on helicopter money and what may be some possible options in the future. If you're interested, feel free to read more. Here's an article from Bloomberg, and it has to do with Mario Draghi. And as they near their next policy meeting there over there in ECB land, it's kind of like, it's funny that they've surveyed several economists, and they have a lot of charts here, more so economists betting or kind of guesstimating on what will be the next means of QE and bond buying. And so just to point at a couple here, it says more than 80% of economists in Bloomberg survey expect such a decision, would mean more easing, with a similar share predicting the ECB will tweak its purchasing rules to avoid running out of securities to buy. Almost half of respondents foresee action on Thursday when the governing council sets policy in Frankfurt. Draghi's position is reminiscent of the one Baron Bernanke faced in 2012 when the then chair of U.S. Federal Reserve added his third installment of asset purchases, so-called QE3, and promised to keep going as long as necessary. The ECB head has repeatedly said officials will keep up their stimulus until they see a sustained adjustment in the path of inflation, and the signs aren't that they take more than another 6 months. And so here's a graph here which just basically says mark your calendars. This week's ECB meeting is most likely opportunity for more stimulus or QE changes, and so the chances of additional QE, it seems to be about 45%, a lot higher than the changes that might need to be made. And then October, still higher than, so more QE is needed. And then around December 8th, economists are kind of saying that they're going to dial back a little bit, things like that. And then apparently, I guess in QE quarter 1 of 17 and quarter 2, there's supposed to be no stimulus. But I'm pretty confident to say there will be another version of stimulus being implemented. Here's what's next from the ECB. 4 or 5 economists predict more ECB stimulus, with most anticipating an extension. And so here, extending QE past March 2017, you have 100% of those surveyed said that they're going to go well beyond March. And some say deposit rate cut, about 30%. More long-term loans, 20%. Benchmark rate cut, 15%. So it's good to say QE is here to stay, and eventually they're going to end up changing the name to some other form of, some other term to make it more positive looking to, more appealing to the public. So more graphs here if you want to check it out. Just interesting how even economists nowadays are pretty much saying that, QE is here to stay, if not get worse. Here's an article here from Market Watch, and it has to do with the idea that the ECB's QE bond buying hits a $1 trillion milestone. Hoorah! They've created $1 trillion to buy liabilities from other governments in the form of bonds, which people think are actual securities and assets worth having in their investment portfolio. But anyway, here, the European Central Bank's quantitative easing program passed a milestone last week, topping 1 trillion euros in purchases after 18 months of aggressive bond buying. ECB figures for the week ended September 2nd show the central bank has now bought 1 trillion sovereign debt. The bank is using a so-called capital key to determine how many bonds from each countries it should buy, with the amount proportional to a member state's gross domestic product. As the end of August, the ECB has bought 238 billion in German bonds, 189 billion in French government paper, 164 billion in Italian bonds. The central bank announced its QE program in January 2015 in an effort to boost growth and inflation across the Eurozone. Inflation in the bloc is currently at 0.2%, well below the ECB's targeted of close to 2%, which has prompted heavy debate amongst economists as to whether purchases are working as intended. So they're not getting the ideal inflation or devaluation of the paper like they had planned on. So what will they do? Just continue to print, in my opinion. Article here is if you're interested in reading more about it. Well, here's the last article here from Zero Hedge, and this has to do with more data kind of revealing that things aren't as good as the mainstream media might want to paint them. And so here it says service economy crashed to February 10 lows, confirming manufacturing collapse. And so it says here, following this last week's disappointing manufacturing ISM PMI data, services PMI printed a 6-month low, 50.9 over the weekend, pointing to an annualized GDP growth rate of a mere 1%, according to market. Services jobs fell to their weakest since December 2014, but the ISM services data collapsed to a 51.4 lowest since February 2010, with new orders imploding to their weakest since January 2014. So once again, data doesn't seem to lie. It more so paints a clear picture of what's really going on. And so here, I don't think this graph is telling anything that's not really true. And the fact that there is a problem in our economy. And as of now, there has been and will be no recovery anytime soon. So just more graphs here if you're interested in checking it out. And as always, hope you guys enjoy these short news summaries. I want to encourage you to share these with other people so that they can become more monetarily aware. And if you're new to the RTD news updates, feel free to subscribe below to be alerted when they're first released. Looking forward to bringing you guys more news and more updates as well as interviews. Enjoy your day and enjoy this information here. Have a good one.